afternoon. Nice to see so many of you once again. I'm going to go through the usual format, for which I apologise if you think you've seen it before. It's because you have. I personally think that's a good thing. I think it's good for us to sort of run through some of the fairly standard format material, because it's wise to, I think, to remind ourselves what it is we're doing and why we're doing it as part of the presentation. So, as I say, if you think you've seen this before, it's probably because you have, and I apologise if it bores you a bit, but I think it is quite a good idea to do that. That's the disclaimer, which, as you know, we are bound to show you, and we should show you, and you should take the opportunity to read in terms of the things it tells you about investment of this sort in an equity investment trust. Why did we do FEET? Very briefly, I think you're familiar with what our reasoning was for doing FEET. Growing demand from investors related to our first fund, the Fundsmith Equity Fund, about direct exposure to emerging markets. Did we own any companies that were headquartered and listed in emerging markets? What did we think about companies' exposure to emerging markets, etc.? And it's a considerable oversimplification, but nonetheless true to say that we like emerging markets exposure as one of the drivers of growth in investment value amongst our companies. That something in the mid 30% of the revenues of the companies in the Fundsmith Equity Fund come from emerging markets. And I would guess that if we were to come back and look at that in 5 or 10 years' time, even if we held all of the same shares, that percentage would be higher, because it is just growing more rapidly. Unsurprisingly, perhaps they're growing more rapidly. They're growing more rapidly because of the attractive demographics and growing spending power of middle-class consumers in developing countries. A pretty well-developed, defined trend, which of course may or may not continue, but our thinking is that it will continue. And we launched this different vehicle as an investment trust because we're investing in things which are significantly less liquid. The simple average, not the median, but the simple average market cap in our fund here is about £5.5 billion, whereas it's nearly 20 times that in the main Fundsmith Fund. So these are much smaller companies. And whereas in the main Fundsmith Equity Fund, 95% of the shares are in free float, in the emerging markets, we are almost invariably investing alongside another major shareholder, sometimes a family or founder, sometimes a conglomerate that's spun out of business, sometimes a multinational company, sometimes a government that's a major shareholder alongside us. So only about 40% of the shares are in free float. So if you take 40% of 5.5 billion, so if you sort of think of that as about a couple of billion versus 95% of 90 billion, the liquidity is quite different. And in our view, you shouldn't ever combine limited liquidity, like these shares that we invest in emerging markets. Not small companies, but the liquidity is more limited than it is in the main fund that we run. And by that free float, we don't think you should ever fool yourself or your investors by having an open-ended structure, by which you can bring up any day and ask for your money back, and we can't sell some of the underlying securities to satisfy your requirement if that occurs. People have done that from time to time. They've done it in emerging markets. I think it was New Star that had an Africa fund, which during the financial crisis managed to more or less vaporize as a result of people taking money out, because you're fooling yourselves and them to believe that you can actually sell something to provide liquidity. And of course, it happened with almost all of the real estate investment trusts in the UK after Brexit, when people wanted their money out, rightly or wrongly, and basically you can't sell your shopping centre on the spot to satisfy them. You shouldn't combine things that advertise liquidity to investors, like open-ended funds, when you're investing in something of limited liquidity. So that's why we thought there was an opportunity here to capture. There was a growing demand for it, and rightly a growing demand for it, and we needed a different type of structure to our main fund. There are lots of slides like this, and if you've been to any of this presentation, you'll have seen them all in the past. I've only put one in today. It's about the growth in the middle class in various parts of the world. The green bar, my point is just about working. The green bit here, that's clearly the bulk of this and growing quite a lot, is the Asia-Pacific region. This is Europe, and this is North America. The period is 2015 to 2030, so once we get beyond about here, we're into forecast rather than reality. But this trend has been evident in the past. It continues to be evident at the moment, And I would say it's almost certainly right that the vast majority of the growth in consumer demand in the world will come from here and not from here. We're not making very many new consumers in the developed world, and we're also not becoming very much more prosperous. Whereas people in the emerging world, the population is in many countries growing, and they are crossing the line into the daily prosperity that enables them to become consumers, and they aspire to become consumers as well. It's something that they actually want to do. So that's, if you like, the tailwind that has existed, continues to exist today, and we hope will continue to exist, believe will continue to exist for as long as we continue doing this. How do we invest? Again, I think you're familiar with this, but let's just remind ourselves and test it perhaps. We have a very simple but not always easy, unfortunately, simple 3-step strategy. And it's most deliberately in this order. We try to invest in good companies. We try not to overpay when we're buying their shares, and then we try to do nothing. The most difficult part of it is the third bit, actually, by far. As you'll see when I go through the numbers, it's quite difficult to get to do nothing, but we endeavour to do nothing. Just running through each of those, only invest in good companies. We've got a long, detailed, I would suggest to you, well thought out and stringent definition of what's a good company. As I often say, the good news is we haven't got time to go through it today. But there are 4 bullet points on what we think defines a good company. They make a high return on their operating capital employed in cash. The cash they generate divided by the capital employed in their accounts is a high number. That's very important. I think it's the single most important measure of whether or not a company is creating value for you in terms of financial measures. They are able to grow. It's no good making high returns without growth. You need something to be able to invest the cash flow and profits in that enables you to compound in value. One of the miracles that equities perform, which is almost completely missed by people when they're thinking about asset allocation investments, is equities are the only asset class where a portion of the return that you're being given by the company, the cash flow that it's generating, the profits it's generating, is automatically retained. On average, about half of that is retained in the business and reinvested in the business. It's invested in capital expenditure, working capital of the business, research and development, and that then, if it's reinvested at a high rate of return, is what generates the compounding for you. No other asset class does this. If you own this piece of real estate and it's rented out, you get a check for the rent. That's fine. It's not reinvested in real estate for you. If you own bonds, you get an interest coupon. It's not reinvested in bonds for you. That reinvestment by the companies at their whatever rate of return they can generate is the thing that generates the compounding that equities produce better than any other asset class. It's a really misunderstood subject and very little mentioned. People come out with lots of mantras and sayings on investment, including me. One of the ones that they often come out with is that the majority of the return over the long term in equities is from reinvestment of dividends. That is wrong. That's not where it comes from. I'll show you some slides later that hopefully will demonstrate that it's wrong. Because what happens if you are reinvesting the dividend is the company makes a profit. It pays out typically about half the earnings in a dividend. You then pay some tax on the dividend, typically. Not many of us are non-taxable for dividend income. There are obviously some institutions which are, but as individuals, we're mostly not. You then can go and buy the shares if you wish to reinvest at the current market price, which if it's a good company making a 30 or 40 or 50% return on capital employed, the market price will be a multiple of the book value. So for every pound of capital you're buying, the market price of that pound of capital will be 3 or 4 or 5 pounds in the share price. That is nowhere near as efficient as the company retaining that money instead of paying it to you as a dividend. You then don't pay any tax on that. They don't pay it out for you. So there's a first advantage. Then they invest it at their rate of return, the 30, 40, 50% on this good company. And the minute they do that, typically, it becomes worth a multiple of the nominal value in book value. If a company's making 30 or 40 or 50%, it doesn't trade at 1 times book value. So the pound of your capital that they retain, suddenly, by a piece of magic, becomes worth 3, 4, 5 pounds. That's actually the thing that equities do that nothing else does. That's why growth is important in terms of delivering. But so is return on capital. It's no good delivering lots of growth with no return on capital. I can do that if you want me to. Occasionally I do that, as you probably noticed. But for this morning, the largest online Chinese travel agency, a company called Ctrip, reported, we don't own any shares in it, And it's growing quite healthily. One of the strong trends in emerging markets is the growth of travel by the Chinese population. If you go on holiday anywhere, you almost certainly can't fail to notice this. If you just go to the Cotswolds, you can't fail to notice it in terms of the signs outside the pubs that are out there, which used to all be in Japanese, and now there's quite a lot of Mandarin outside those pubs and tea shops and places like that. And you might say, well, why didn't you own any C-Trip? The return on capital employed is 1.9%. You too can grow a business at quite a clip if you don't need any return, because you're clearly not adequately charging the customers to make a return on capital. Well, it's easy to sell things for the wrong price. It's more difficult to sell them for the right price. It's even better to sell them for far too high a price if you can get away with it. So that's why that's important. We like companies that make their money from a large number of everyday, repeat, predictable transactions. We're looking for consumer growth here. So we're looking for the everyday necessities, luxuries and addictions that we've got. I mean, addictions in the widest sense, not literally necessarily in every case, but the things that we consume as a matter of habit. That we go back and we're loyal to. And we like companies that have got a position that they can defend against competition. If you've got a company that's got wonderful returns on capital and is growing like Billy-O, people should come and compete with that and grab that market off them and take that return on capital from them and so on. That's the natural laws of economics, a thing called mean reversion. We like companies that have got a defensive mechanism that enables them to defeat that competition. It's a bit passé to quote Warren Buffett these days, even though it's quite a good guy to quote, but everybody seems to do it quite often without actually understanding what he said, it seems to me. One of the phrases that he uses when he describes this is the moat. I don't particularly like the phrase, but I haven't thought of a better one. You're looking for something that they can defend. The castle that they're defending is these fabulous returns they've got. The moat is the mechanism. What's their market share, their brand power, their pricing power, their control of distribution, their know-how, their client relationships that enable them to keep a hold of these returns. Otherwise, we can find companies with high returns, but they disappear in competition. So that's what we think is a good company. When we look at emerging markets, this is a comparison that immediately illustrates it. So if you're saying, well, the two things in financial terms you're looking for are a high return on capital and a high growth rate, we can make a very direct comparison. It's not the whole of our portfolio, but we can look at companies' return on capital employed, and we can look at their last 5-year compound annual growth rate, CAGR, in revenues, the sales revenues, and we can make some very direct comparisons, not all of which we own, between the parent company, which is the light, I guess they're sort of, I don't know, maroon or something bars, and the darker ones. The darker ones are a local subsidiary, a quoted subsidiary like Ambev in Brazil in brewing, and the smaller one is the parent company, AB InBev in that particular case, or BAT Bangladesh and BAT, or Colgate-Palmolive India and Colgate-Palmolive. And if you look down that, you will see that the returns on capital of the emerging markets quoted subsidiaries, many of which, but not all of which we own, are much, much higher than the parent. The only one that isn't is Kimberly-Clark. The Kimberly-Clark Mexico business makes a slightly higher return, but that's because it's got a lot of cash. If you took it's got a very large cash pile at the moment. If you took some of the cash out, in fact, took all the cash out to get it back to the point where it was just neutral, no debt but no cash, and it paid out the cash, it would actually go up to about a 56% return on capital employed. So it's the only example that's the other way, and it's the other way for a particular peculiarity which won't always exist, I suspect. And if you look at the growth rate, so yeah, they've got good returns, but are they growing? These are the growth rates in those local subsidiaries versus their multinational parents. Yeah, it would appear that there are lots of companies in emerging markets which we can own, which are capable of generating much higher returns and better growth rates than their parent businesses. And that's true even when they're not owned by multinationals, which is only the multinational. It's just an easy comparison to make. There are lots of good companies in markets making great returns, but there are quite a few that make very poor returns, which we seek not to own. This is a comparison between an Indian consumer products company that we own called Emami, and you can see here's the last 10 years returns on capital employed. They go up and down a bit. And there's the growth rate, so 10-year cash flow growth, 29% compound annual growth rate. And here's a company that we don't own at the moment, which is a consumer electronics, an electronics business on high precision industry, where you can see the returns are A, much lower, and B, pretty much going down a bit and not much above the cost of capital for the company. Now you might, when you're looking at this, oh yeah, but look, I mean, Imami's come off in the last couple of years. This is a trend that's going to sort of come down here and meet this one. I doubt it. I mean, we'll get on to India perhaps a little more in a minute. As you know, we've got a very big Indian exposure. India's been very disrupted during the last 2 years by two things. One was the demonetization, where the high-value notes were withdrawn, and the other one has been the introduction of the nationwide goods and services tax. So the numbers that have come out of the Indian consumer sector for the last sort of 24 months are, I would suggest, quite close to meaningless in terms of trend. It's what's going to happen next over here as those two events fade into the distance of the past and we see what they've done to the economy, which I think will be very positive. We'll start to see it. But even as things stand, I'd rather own this one with these sort of returns and 29% growth than this one with these very low returns and 10% growth. It's quite clear I'd rather be there than there, personally. And it's not just that, you know, there are some companies that we can find like this. Sectors across the globe have these characteristics. This is from a professor who works at Stern Business School at New York University. And I know this is just 1 year, but this is data he produces regularly. I can get other years if any of you are interested. You can see he looks at sectors around the world, and he looks at the return on capital employed, looks at their cost of capital, their weighted average cost of capital, WACC, deducts one from the other and looks at what sort of return they're making above their cost of funds. And you can see, here's a list of good sectors, in his own parlance, and here's a list of worse sectors. So he thinks, you know, tobacco, advertising, healthcare, IT, household products, beverages, soft drinks, business and consumer services, retailing, computer services and entertainment are all very good, respectively good industries. What's bad? Oil and gas production, brokerage and investment banking. There's a shock. It's like owning a soccer club, being in investment banking. The staff take all the money. The shareholders don't have anything left. Banking, money centre banking, banking regional. More oil and gas, financial services, non-banking and insurance, shipbuilding, oil and gas. You're getting the general drift. Right? We're not interested in owning any of this stuff. It can do well for periods of time. It certainly does well at certain stages in the cycle. It can do well if it dominates indices and there are big flows into the index funds and so on. Over time, though, these companies cannot produce that miracle of capitalism that equities produce, of reinvesting our money at a high rate of return, for a very simple reason. They don't make a high rate of return. They do not consistently make a good rate of return. Growth trends, you know, it's all very well to find growth in percentage terms or return on capital in percentage terms. We like to try and understand and think we understand the fundamental business reason why the growth is there, because otherwise you've just found numbers. If you don't know why the growth is occurring, or you don't think you know why the growth is occurring, maybe it's something that's a temporary trend and is going to cease. Is it something that you understand that you can measure that will continue into the future? So we like to know what it is that's driving it. I won't go through all of these, but it can be things like formalization, as we call it there. That's when people move from buying their products in the retail from the so-called informal sector, kiosks, on streets, moving into what we moved to into a society about 50 to 60 years ago, which is into branded retail outlets which are national or regional, basically. The one that we own there, which is represented there, is a thing called Philippine 7. They own the 7-Eleven franchise, the convenience store franchise for the Philippines, and they are the runaway winner. They've done a brilliant land grab, basically, in getting the leading position in that. It can be things like digitization. We're obviously familiar with digitization. The eBay stroke PayPal of Latin America, which we own, is called Mercado Libre. My colleague Jonathan will correct my pronunciation if necessary. Jonathan, where are you? That was okay, was it? You let me know when I go wrong. It can be things like healthcare, diagnostics here. We've got IDHC, which is an Egyptian-based diagnostics company, which is a market consolidator. Or it can be in preventive diagnostics. We've got an Indian company here, ThyroCare, obviously thyro from thyroid, which is in the wellness end of diagnostics. It's not one that you primarily go to get diagnostics when you need a diagnosis of being ill. It's one that does preventive diagnostics work. So the sort of things that we all get for our medical checkup. It can be things like Chinese travel. I said to you that we don't own C-Trip because the returns are too low. The company that we do own, that's plugged in very centrally to Chinese travel, is Travel Sky, which is it's like, if you're familiar with our main fund, Amadeus is the company we own that is the Madrid-based world-leading airline reservations business. This is the Chinese one. This one's got significantly over 90% of the Chinese market. So when people make airline reservations and they process passengers, this is the recipient of those revenues. So those kind of things. I won't go through them all because otherwise we'll never get the presentation done and allow any time for you. Sector split for us. There's our sector split. You can see nearly 70% in consumer staples, 13% now in healthcare. We've increased that fairly significantly in the last year. We've found more and more opportunities to get into healthcare. It's actually our second biggest sector in the big fund that we've got, and we think it is or can be clearly linked into growth of the consumer. Bit of consumer discretionary, bit of information technology. Again, we've found ways in the last year or so. Mercado Libre is one, Travel Sky is another, and those things. A bit of industrials and materials. Try not to get too worried about that. We're not sort of forgetting what the mantra is here. They are things which are very directly linked to the consumer. So it's things like Asian Paints, which is an Indian paint, the leading Indian paint manufacturer. The vast majority of their sales are made to consumer. They're not mainly an industrial paint manufacturer. They don't mostly make paint to supply to the motor industry and people like that, which is not a particularly good business because you have to deal with purchasing managers and people like that. And it's highly cyclical. They actually sell direct to the consumer. So that's it. And we've given you here a somewhat more detailed breakdown because particularly this one is a big lump. So you can see it breaks down into food and beverage, fast-moving consumer goods, so consumer goods which you don't eat and drink, unlike the food and beverage one, so your cleaning products and your laundry products and your personal care products and so on. Healthcare, which is the same as the one over there, so that one's exactly the same. Retail, tobacco, IT, which are the ones I mentioned, and as I said, and fast food here, basically. Autos is, we own a stake in Eicher, which is the Indian manufacturer of the Royal Enfield motorcycle. If any of you are familiar with Royal Enfield from your youth, I certainly am. So that's where the auto exposure comes from. Remember the fourth point that I had on my good company slide earlier, what protects you against competition? What have they got? Well, they've usually got one or more of these sort of things. It's things like their brand. That's a Indian company called Marico. That's their main brand in the coconut hair oil market. They've got 60% of the market with that thing. This is it's a very powerful market position that they've got, and it gives them, the brand not only gives them that, it gives them pricing power. They've managed to grow this at 6% per annum. At the same time as putting through a 38% price increase. Now, they put through the price increase not just because they like putting the price up, but their input costs went up. If you don't have strong brands, you don't have the protection of being able to pass that on to the consumer. If you've got powerful brands, that's what you can do, and it protects your return. And again, I said I won't touch upon all of them. There are a lot of different ways that things can be protected. With Travel Sky, it's an installed base. All the Chinese airlines use it. Sometimes it's distribution. Asian Paints, the one I talked about a moment ago, have twice as many distribution outlets as the next nearest competitor in India. Sometimes it's regulation. Our largest shareholding, which has actually gone up very significantly since we started, is Eastern Tobacco in Egypt. If you're invested in tobacco, you might have a great many concerns, but one of the ones that you often encounter is government activity. We're unlikely to suffer at the hands of the Egyptian government in this particular case, given that they've got 55% of the company. I think they can see their way to doing things that are reasonably shareholder-friendly, and we have a good dialogue with the minister who controls it there about what we'll do, what they will do with their marvellous cash flows. And it's things like that. Over here, Professional Advocacy, Eris Life Sciences, a drug company in India, and it gets most of its drugs prescribed not by GPs, but by specialists in the area that it operates in, which is things like diabetic care and cardiovascular. The specialists in that area are advocates for the drug, basically, which they supply. So I won't go through them all, but there's usually something that we feel we can spot that protects us against the competition. But the acid test is, not only do we own good companies by numbers that we can work out, how do they compare with other things? So here's 5 things. The return on capital employed for the last year, the gross margin, so the difference between sales and the cost of goods sold, the operating margin, so that margin less all their operating expenses like sales and administration, how much of profits they convert into cash, and what the free cash flow grew during the year. And we've given you our portfolio, so we look at our individual companies, weight it for their holding in the portfolio and calculate that for you. And we compare that with both the indices, which are our benchmark, the Morgan Stanley Capital National Emerging Markets and Frontier Markets indices, and we compare it with our main fund, the Fundsmith Equity Fund, to see what we're getting. So we're getting companies with a 48% return on capital employed. The index companies produce 15. This is pretty good, I think, 28. The gross margin is 50%, so they basically double the price of the things that they put in. It's not as good as this one over here. That's because, if you remember, we have a reasonable percentage in retail. Retail is always, as a distribution business, a lower gross margin business. So that's absolutely bound to be lower than that, but it's significantly lower than that. The operating margin, you can see there is a little bit lower than this. The retailers, again, not a lot higher than that. I mean, this is our calculation from our portfolio. For what it's worth, we're not very happy with that Bloomberg number. We think that Bloomberg number takes a lot of other income, which is exceptional in from time to time, into the calculation. It's not the sort of calculation of real operating income that we can get when we do it for our own companies. And obviously, we can't go out and do it for the whole index. We have to call the number up from Bloomberg. But we think that's why that looks reasonable in relation to that. Free cash flow, they generate more than 100% of their profits in cash. For those of you who are fortunate enough not to be involved in accounting or investment, that is a possibility, that you actually generate more cash than profits, typically by paying people more slowly than you get paid. And if you do that, you can turn a pound of profits into more than a pound of cash flow. And certain industries and companies are very good at doing that. There are other things as well, but that's one of the main ones. And lastly, the growth. If you remember, I said that this is important, this return, and I said this is very important as well. It's the equivalent growth number. What's their free cash flow growing at? Well, 26% last year, which is actually exactly twice what we achieved on the big fund, and compares with 16% in the market. On the numbers, looking admittedly in the rear view mirror, we've got good companies. And if you remember, you've seen the rear view mirror now 4 years running. So it hasn't changed significantly. We're not, this is not a spot calculation which appears to be moving adversely. In fact, if anything, it's moving up. If you call up the same table, if any of you got it from last year, you'll see that's gone up by 3 points, and that's gone up by a couple of points as well in the last year, the growth rate. Now, it's not our requirement that the growth rate and the return on capital continue going up forever, because clearly they can't. That's not what I'm trying to indicate to you. What I'm trying to say is this is not sort of a snapshot, and actually, in a moment, I think they're going to be a lot worse. It does appear to be a pretty, there'll be some ups and downs, but it's a pretty sustainable trend. Other things to say on look-through characteristics. I mean, we've touched upon this already. These are the median numbers, which is why they're different from the ones I gave you. I gave you simple averages earlier. Our median company is 3.2 billion of market capitalisation or market value versus 47 in the main fund that we've got, and the index is about 4.4. So we're slightly smaller than the index, but as you can see, we are very significant small, hence the closed-end nature of our fund. We've got 49 holdings. We've trimmed back a few in the last year. Ones for reasons that we will go into that we sold, or where we were unable to obtain a sufficient holding to make it worth carrying on with it. That was the case in one IPO, which is higher than this here still. The event risk, although we haven't had much event risk really in terms of bad things happening in our company, is greater in this area. That's why we have more holdings. The companies weren't founded yesterday, however, even with some increase in our investment in IT, which almost by definition is going to bring you into more recently founded businesses. Our average business was still founded in 1966. These things have been through a few business cycles, basically. That's good companies. That's by far the most important thing, in my view. Do we own good companies? Because if we do own good companies, we will eventually see the benefit in terms of the performance of our fund. I'll hope to illustrate that in a moment. Don't overpay. That's the second part of this, but it is second for very good reason. It's not the most important thing. I've often said to people, I wish that I'd kept a diary from when I started work 42 years ago, with 2 columns in it. Column 1 would be people who asked me whether or not the company that they were thinking of investing in, or I was recommended or analysing, was a good company. Is it a good business? And then in the other column, they'd ask whether it was cheap or expensive. Is the company, or shares, or the market, or the strategy, or the fund cheap or expensive? And I don't know, because I didn't keep the diagram function, but what the exact balance would be. But the vast preponderance of what people ask is about whether things are cheap or expensive. They very rarely ask about whether they're good or not. And that's the thing that you really, I think, if you are a long-term investor, need to know. And if you're not a long-term investor, by the way, you're in the wrong fund. Whichever one of our funds we're talking about, you're in the wrong fund, because we are endeavouring to be long-term investors. And I think people focus on the wrong things. However, we don't go out and try and overpay for things. So what are our companies valued at? The free cash flow yield on our companies, so you can see here, that's the cash flow they generate divided by their market value, expressed as a yield, is 3%. It's a lot lower than the MSCI index, and it's a reasonable amount lower than here. So they are more expensively related. Think of the reciprocal of that. These are on about 33 times their free cash flow, and these are on about 20 times their free cash flow, so they're more expensive. There's absolutely no doubt about that. There's the dividend yield for comparison. Actually, it's quite close to our main fund there in terms of dividend yield. However, people talk about, and they go, oh, that's expensive. 33 times cash flows versus 20, it's expensive, isn't it? Expensive on its own doesn't actually mean anything. It's like when people ask, as I say, over 42 years about these things, they go, well, it's cheap, isn't it? Well, but yeah, but if it's a really bad company, maybe not cheap enough. And if it's a really good company, maybe it could get a lot more expensive. There's no absolute sort of level here at which something is automatically cheaper. You have to relate it to other things, like the growth rate, like the returns it makes. And the fact of the matter is here, if you compare it with either the index or the main fund, and probably our main fund is a better comparison, because clearly the 955 companies represented in here are vastly different to the companies that we're prepared to invest in. So this is a better comparison over here. We're actually, if you look at this, paying something of the order here, you'll see, of about 20% more, if you did express that as a reciprocal, in terms of this. But we're getting, as you can see, something like, we're getting exactly twice the growth rate, so 100% more growth rate, and we're actually getting over here quite close to about 2/3 more in terms of return. Now, there's not a precise scientific way of expressing that for you, but clearly the premium we're paying in terms of pricing is a lot less than the premium we're getting in terms of either returns or growth rate. So I would suggest you, if you start thinking about cheap and expensive, not just in terms of, well, it's a number that says cheap, relate it to the growth rate and return you're getting, and relatively speaking, I feel comfortable. Actually, the problem is, this is only something that you can express relatively. Valuation isn't something that exists in a vacuum. You've got to compare things with other things to get a valuation, just like you have about anything in your life, your car, your house, anything. You can only do it by comparing it with something else. So that's what we're endeavouring to do here, to give you a picture on valuation. To illustrate that this is not the most important thing, and I may have shown you this example before, so I apologise if I'm repeating it to you. This is taken from a Warren Buffett quote. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, is one of his sayings. It's not conjecture. He's not putting forward a theory here. It's just a fact. So if you took two companies, A and B, and you were going to invest over 40 years in these companies, your £1,000, basically, with £1,000 of net income or net profit, A with a 20% return on capital employed and B with 10, which one would you like to invest in for 40 years? Well, hopefully with me rambling on about return on capital employed, I could get some of you to buy that one. Yeah? And to save any difficult mental arithmetic, neither pays a dividend, so they retain all of their earnings, that miracle of equities, and they have the same tax rate. So obviously A looks better than B, but the problem is, at the beginning, A is on a price-earnings ratio of 40, and B is on a price-earnings ratio of 20. I mean, unsurprisingly, A is more expensive than B. So there we are. All those people who ask me about expensive versus cheap are going to be in B, aren't they, at this point? They're going to go, yeah, well, A is a better company, but B is far cheaper, so I'm going to be in B. In terms of our single investment choice for our lifetime, this example only gets worse. On the day when you come to sell it, when you sort of want to retire and live off the income by putting it all into bonds and seeing how much money you can lose in bonds, which is typically having a go at it, the rating on this one has halved. It's gone from a P of 40 to a P of 20, and the rating on this one has doubled. It's gone from a P of 20 to a P of 40. I don't know why. I've no idea. It's a fashion at the time. Companies of this sort, which are highly cyclical, leveraged, and whatever, are back in fashion for a period, and it's very unfortunate for us in timing. So at this point, this one's a better company. We know that, right? But look what's happened. You know, our valuation has halved, whereas the valuation of the bad one has doubled. If you calculate what would have happened there, that's what would have happened. Your very, very poor timing on A would have cut the return not on the company but the shares. We've got enough data there, believe it or not, that's a simple example, to tell you the share price on day one, what it would have gone up at. It would have compounded, not at the 20% the company was making, because our timing was bad. We'd have cut it to 18% per annum. That's what the value of our share would have done. Right? Whereas B, the genius of the person who was worried about valuation and studied it and bought that when it was half the valuation of our good company and sold it when it was twice the valuation of our good company, would have boosted their share return to a whole 12%. If you're a 40-year investor, if you're starting here and holding it for 40 years, the difference is the person who got the valuation right on this one but selected the poorer company would have made £9,000. This person over here would have made £73,000. Getting compounding of this sort right makes a vast difference to the outcome. It's difficult for us to comprehend that in terms of our mental image of the difference that it makes. That's 6% per annum. This is another illustration of it, but this is a live one. To illustrate this, what I've done is an example here where we've got to imagine that you live for a very long time and you're very clever and you invest from a very early age and see the results. And what it is your brilliance in terms of timing and valuation enables you to buy the S&P 500 at its low point in valuation in the 20th century and sell it at its high point. So you really played this valuation thing with the world's most important index, biggest index, perfectly. You would have bought it in 1917 when America entered World War I, and the PE, the price-earnings ratio, was 5.3. You were buying the average S&P company on 5 times earnings. Sounds pretty cheap to me, I've got to tell you. And you'd have sold it in 1999, so you had a pretty good innings, frankly. You'd have sold it in 1999 on 34 times earnings at the peak of the dot-com boom. Pretty good going, eh? So you'd had an 82-year run, and that performance would have delivered you 11.6% per annum compound return with dividends, net dividends reinvested. Well done. How much came from the uplift in valuation, and how much came from the companies just reinvesting the retained earnings at their rate of return? Well, we can calculate that. If you've got a calculator like the trusty Hewlett-Packard 12C, which is the industry standard and has been for about 40 years for calculating compound returns, if you were to put in minus 5.3 PV, present value, 34 future value, 82N for the number of years, and press I, it will do an iterative process, if you're familiar with it, and it will tell you how much of that return came from, per annum, came from that uplift in valuation. And the answer is 2.3%. So of this 11.6, 9.3% came from nothing to do with the uplift in valuation. It came from the companies compounding in value by reinvesting the cash flows at the rate of return they're able to generate. I'm sure you're all familiar with the Pareto principle, otherwise known as the 80-20 rule of life. It's 80% of the consequences come from 20% of the actions, roughly speaking, is the rule of thumb. Hey, 80% of this came from nothing to do with our brilliance in terms of timing, nothing to do with our brilliance in terms of playing valuation. It came from just owning 500 companies that kept reinvesting. That's what we're seeking to achieve here. Now, that's what you get as a result if you invest in 500 companies, which pretty much by definition must be average when you think about it. 500 companies are going to produce average returns. Yeah? How about if you invest in a good company? One that made high returns and could reinvest at a high rate. This is Unilever for the last 20 years. Okay? Unilever, if you'd bought it in 1995, you'd have been buying it on a P of 16.8. And if you'd sold it in 2016, you'd have got a P of 21.1 for your shares. So yeah, you've played the valuation. If you do the same calculation with your HP 12C, you will find that of the 10.9% that Unilever has returned over these 20 years, 1.1% came from, per annum came from the uplift in valuation. 9.8% came from what Unilever did, with them investing at a higher rate of return, basically, in their business. That's what happens if you invest in good companies and you hold them for long enough to let them do this, basically. That's what we're seeking to achieve here. Right, so try and invest in good companies, don't overpay, then do nothing. This is the bit I'm really bad at. I mean, you think I'm bad at the rest of it. Wait till you see the results of this, as it were. The turnover in the fund last year was the same pretty much as it was the year before, which is 34%, significantly higher than the turnover of our main fund, and higher than ideally we would like it. We actually incurred, by our voluntary action, 0.18% of dealing costs through that, and as you can probably tell, I'm not entirely happy with it, but I can't remember who it is when, I think it was a politician, when once asked what the cause of things going wrong would be, he said, events, dear boy, events. Who was that? Thank you. Thank you very much. Yeah. That's what I have them for, you see. That's what we have non-execs for. Oh, yeah. Old, knowledgeable non-execs. Events. We took a stake in we think, the best retail business in India at IPO, D-Mart, and we didn't get a sufficient stake, and the valuation, frankly, was so great that we sold the thing. That's that. We also got out of companies which started to acquire the disease, which some emerging markets companies seem to be prone to, of deciding that their future is in the developed world. That's not what we own them for. And so when Jollibee, the Philippines-based fast food franchise business, decided that their future was in buying a company called Smashburger in America, we decided our future was in being invested somewhere else. And so that's what we did. So there was an element of events, basically, doing it. So things like that. The other thing was, if you remember, I said earlier that we found ways to invest in a couple of sectors that are more difficult to obtain here. And we did actually significantly increase our investment in healthcare and in technology over the period. So about 10% of the portfolio, in terms of turnover, and of course you've got to take that on both sides, so it's like 20%, you've got to sell something and buy something else mainly, if you're fully invested, was actually our voluntary action of trying to get heavier in the healthcare and IT sector, which we believe will produce benefits for us in terms of another source of high return companies with high growth, basically. So it's a combination of some events and that. I keep saying this, but I'm hoping I'm going to be standing here in front of the same audience at some point, and that number will be very significantly lower. Ideally, of course, it would be zero, but we'll never get to that happy state. But that would be the perfect position to be in, where we just sit there. I don't know if any of you are familiar with this, but there's lots of research about the outcome of private investors that's been done from the data that's available. And some of the two examples that particularly spring to mind are private investor data that they can get that shows that some of the best performing investors that wealth managers and private client brokers have ever had are people who are dead. Because what happens if someone dies, but their estate doesn't pick up that they've got an account with somebody, and it's only discovered many years later by some means of somebody somewhere opening, and that's when they go and have a look. They're usually amongst the best performing clients for the very simple reason they haven't done anything. I'm not making this up. There's a man called Michael Mauboussin who did a big study. I think I may have mentioned a big study on American wealth managers and retail brokers. And he looked at, particularly from World War I on for 2 or 3 decades, when typically the way in which people were treated in investment differed very much between the sexes, which is to say men who had some money to invest typically had a relationship with their broker and played golf with him and all that kind of fine stuff and got the first call from him, allegedly, when there was something to do. And women didn't. It wasn't considered right. Women didn't have this, but they certainly didn't go out and play golf with the broker, and they probably didn't get many calls from him. They certainly go drinking, etc. And of course, the net result of that was, when they looked at the data, the women outperformed the men by such a margin, it was ridiculous. Because of course, all the things they had that were massive winners, which in that post-war period, and there were quite a lot of them in consumer electronics as well as the sort of things we invest in, they never got the phone call telling them to take a profit. And so they did better, basically. It's a great piece of research, and it's a wonderful illustration of the benefits of inactivity if you've got the first bit right. It's no good being inactive if you've got the first bit wrong. Going back. If you've got the first bit right, inactivity is your friend. It's on your side. Evolution of the fund, just to say in terms of how it's evolved, obviously this is the Fundsmith Equity Fund here with some names which we own, and here's the Emerging Markets Trust over here with some names which we also own, which it's evolved into. So, you are familiar with most of these, I think, in terms of Hindustan Lever, Britannia, the biscuit manufacturer in India, and Viceroy, Hong Kong-based soy manufacturer. You're familiar with East African breweries that we've held from inception in Kenya, for example. Healthcare has developed a lot more. It's an important part of what we do in the main Fundsmith Equity Fund. We've got a very big exposure to medical equipment and devices, and a somewhat lower exposure, because we're a little less trusting of it, of the pharmaceutical industry. We've got one holding, 1.5 if you include Johnson & Johnson. And we like people who make testing and diagnostics equipment. That happens to be veterinary testing and diagnostics, although I would be surprised if in a minute it doesn't become human diagnostic equipment as well, because it's actually better than the human diagnostic equipment. because we spend more money on our pet's health than we do on our own, quite often, and pay more attention to it than we do to our own. And we found these things that I mentioned earlier in emerging markets to invest in. I mentioned these two. This one is a Brazilian company, which is basically a Brazilian drug company with a major interest in generics in particular, which is the fastest growing component of drugs in most emerging markets. Branded generics are a feature of emerging markets that we don't, unless we go there or live there or something, you don't see very much. So we understand the difference between prescription medicines and generics. So I can go and buy, ibuprofen, or I can buy Nurofen. There, the Nurofen is likely to be the thing that you sell. It's got a brand value, essentially. And we found that. And I mentioned earlier, we've got quite big sort of applied technology, for want of a better term, holdings here in things like Amadeus and PayPal in online payments. We've found them here as well. We've got industrials here, and we've got some of their offshoots over here. This is Indian consumer electronics manufacturer and distributor, basically. Distributes things like fans, switchgear and wiring that goes into buildings, and most recently air conditioning. The most recent thing is an adventure into air conditioning. So that's some fairly obvious benefits. Okay. How do we compare with the index? This is the country breakdown of our portfolio. As you can see, we are, in fact, a smidge over our limit on India, not because of anything we've done, but because of the rise in the value, relatively speaking, of our Indian portfolios, taking us over our country limit. It's permitted. It's both permitted and to a degree welcome as well. I mean, things that go up are things that we welcome. So the idea of panicking because something goes up seems to me a rather strange one. So we're quite happy with that situation. As you can see, we've got a much lower holding in China, including Hong Kong, than the main China index. We still struggle to find things of the quality that we want in China in terms of returns and ownership structure. So yes, there are lots of big Chinese businesses. Some of them are not unadjacent to what we do, like online travel agents and internet-related fulfillment businesses. Whether or not you actually really own them is an interesting question in a number of cases. What returns they make is interesting as well in a number of cases. We don't own anything in Korea or Taiwan. They are emerging markets, and therefore they are in our competitors. They're not emerging markets by most of the standards that we would apply it. It's judged, whether it's an emerging market, on how its stock market functions, not what the economy is like. I would strongly suggest that both Taiwan and Korea have emerged in terms of consumer. It's happened. Of course, if there's a reunification of Korea, it might make a bit of a backward step temporarily, I guess. And we'll see what happens then. But those are ones that we don't own anything in. And you can see in terms of sectors, clearly, things we are prepared to own. This is consumer staples as a proportion of the index, 6.7%. Healthcare, very small in emerging markets. It's why we've had to work quite hard to find appropriate things in there. Most of the things are not terribly appropriate for us. They're things like hospital groups, which have got a lot of real estate and make really quite poor returns. We're looking for diagnostics, generic drugs and things like that to invest in, rather than things that have got lots of real estate. Some IT, although not much. And some consumer discretionary is of interest to us. The majority of the index is not of great interest to us. Financials, energy, telecoms, utilities, we're not going to be buying any. ETF fund flows, I've shown you this one before. This is since 2012. As you can see, more than 100% of the flows into emerging markets for the period that we've been in business, so coming back to here, has been from ETFs. That's the active, and that's the ETF. It looks as though this is now on the up, and we will see what happens to this. But it does, certainly we've had, at the very worst, a stabilisation in terms of active management in emerging markets, where money that's flowing in is starting to flow into active funds. This one hasn't yet rolled over. I suspect we probably need a bit of a bad period in emerging markets for that one to really roll over, where you will find out that the stuff that you own in that's highly liquid and which is pretty bad in a downturn will get some interesting results from people who are invested in ETFs. So 70% of the inflows into emerging markets last year, even with that somewhat reversal of trend, went into ETFs, not into funds that are active investors, such as us. That's important because there's the top 10 of our portfolio there, and that's the top 10 in emerging markets. As you can see, none of them are of a sort of company that we would own. So, Chinese internet fulfillment, and again, consumer electronics in Korea, consumer electronics componentry in Taiwan, South African company which owns quite a lot of that, Chinese construction bank, more Chinese internet, etc., etc. Chinese mobile, Chinese insurance company. I mean, I don't wish to be insulting, but the idea of investing in the accounting of a Chinese insurance company is a fascinating. I wouldn't invest in the accounting of a British insurance company. So you're taking your fortune in your hands if you do that. So the idea of doing it in a Chinese one, I think, is interesting. We're more concentrated than the index. That's pretty deliberate. Our return on capital employed is much higher than those ones at the top. They've done very well. Something like 40% of the return in the MSCI index last year came out of 3 companies that are on that page. But they haven't done very well in fundamental terms. And the board meeting before, where, as usual, I'm called upon to report to the directors about the investment performance, they, I think quite rightly, question me about what's happening to the fundamentals of the companies in our portfolio more than they ask me about what's happening about share prices. And so the fact that 40% return index comes from those companies does not make me want to run out and own them, and it doesn't seem to make them want me to run out and own them for you either, as far as I can see. Those are the main components. Very busy slide this of the index performance, as you can see over the last year. So you can see the percentage changes last year. You can see the companies which contributed the numbers that I'm telling you there, and this one which owns that one. So the top 3 companies and that one are basically the ones that did this 40% that I'm telling you about. Naspers is a bit of double counting because it owns a big stake in Tencent. Our performance. Last year we made 21%, the index made 24%. I don't know whether to be entirely happy or sad about that, probably a bit of both. Obviously we intend to achieve both making you money and making you more money than you get in the index in due course. We had a very good end to the year. As I've said before, I think when presenting to you, you never get performance smoothly. It just doesn't happen that way. If the market goes up 25% per annum, which it did there are 250 working days in the average year. It doesn't go up 0.1% per day. That's not how it works. It all just arrives in a rush. The ketchup bottle is the analogy I always use, trying to get the ketchup out of the new bottle. It won't come out. You tap it, bang it, shake it, and then all the ketchup comes out suddenly. That's what performance is like. It all arrives just like that, if it's going to arrive at all, of course. And I suspect that's what we will face probably, with a bit of luck at one point, when that will occur. This year's been mixed. We had a poor January, but we've started to improve quite significantly in the next couple of months. I'm not really in the predictions business, as it were. I'm in the trying to find good companies, buying them and doing nothing business is really where I'm at for you. But if I had to predict, the thing that clearly is absolutely central to what we've laid out is what happens in India. India is 40% of our portfolio. There's a quote in an FT publication that was out this morning. They rang me and asked me about it, and they said, well, if you could only invest in one country in emerging markets that might do what America did in the last 150 years since it was an emerging market, which one would you choose? I said, India. And they said, why? I said, well, first of all, it is the largest democracy in the world. Right? More people voted for Narendra Modi than have ever voted for anything on earth. The Prime Minister of India. Okay? Why is that important? Because there's a lot of debate about whether democracy functions at the moment. Sometimes it does well, and sometimes it doesn't. As it happens, I'm in favour of it. I've looked at the alternatives over the years, and they don't seem to go all that well. You can certainly make a lot of money investing in countries which are one-party states or dictatorships, and to some degree we are. I mean, that's where some of our portfolio is. But the problem, I think, with those countries in the long term is they mostly have to make a transition to democracy. And the number of countries that have made a non-disruptive, peaceful transition to democracy is not high. You know, the outcome of that, in terms of investment, is usually a very uncertain process. Whereas democracy, with all its faults when it's established, is good. It also has the rule of law. One of the better things, perhaps, that the British Empire helped to give to India is the rule of law. And that's pretty important. There's no good owning a really good company and finding out that you didn't own it, actually. It's somebody else that owned it, and that there's a state-controlled kangaroo court that makes the decision on the outcome of that. So it's very important to have that rule. Actually, India usually comes in about 4th or 5th in most international surveys of protection for minority investors. That's important. We're minority investors in these companies, right? And as I said, mostly we've got a partner government, family, founder, multinational. It's important that they can't actually steal that value from us. That's very important. And I said, lastly, and by no means least, you've asked me about companies, about countries. Which is the country you would invest in that you think is most likely to emulate America in the next 150 years? And I've said India. But here's the problem. We don't invest in countries, do we? I don't own India. We can only invest in companies. And I think India is the single biggest repository at this moment and for the foreseeable future in emerging markets in the world of really high-quality companies of the sort that we desire. Basically, consumer-facing companies. I think it's the single best grouping of those in the world, and those are the things that we own. There's an old joke that illustrates that. There was a man called Leonard Licht, who some of you will be familiar with, who was one of the triumvirate who founded a company called Mercury Asset Management, which became Merrill Lynch Asset Management, and now Blackstone, I guess, no, BlackRock. Sorry, BlackRock. Blackstone's a private equity firm, isn't it? Who, in the days when the trade figures were a very important thing on the first sort of Monday of the month when they were published, so we got the trade, they still are an important thing, it's just that people ignore them now. But anyway, they used to shout across dealing rooms what the trade figures were, and trading would stop, come to a halt as 11:30 came up and the figures were outproduced. The young trainee who leapt to his feet to try and be helpful in the man's dealing room and shouted, "Bad trade figures," to which Leonard Licht shouted back, "Sell mine for me." His point being, well, what am I going to do with it? And it's the same as, I may or may not be right about identifying India. I think I'm right. And I think there are good reasons to believe we're right, and so on. The fact is, we can only capitalise on that by actually investing in Indian equities. That's the only thing we can do. And I think there are a lot of reasons to believe that that's going to work. We are going to come up in 1st July, having lapped the introduction of the National Goods and Services Tax in India. I think it has begun the transformation of the Indian economy towards being a single national market for manufacturers and distributors, with massive advantages for them in terms of logistics, manufacturing, and reduction of corruption and inefficiencies out there. And of course, we've more than that now, the demonetisation. But don't take my word for it. What I do is I copy in the board when they're interested, which is mostly the case. For anything that I see that's interesting that comes up that either illustrates what we're doing or possibly contradicts what we're doing. They're both quite important. And they see the things that we send over on the commentary that's coming through from the companies. And I would say the commentary that's coming through from the companies in India would suggest to me that we're right about this. I mean, I realise, this won't suit everybody, but one of the other things that gives me really great comfort in the large position we've taken in this is that certain of the media commentators have got the diametrically opposite view. There are certain people who are great negative indicators out there in the world. There's a man called Barton Biggs who was a strategist who ran a hedge fund, wrote a book called Hedgehogging. And in his book, he describes a broker, and if you ever worked in the investment banking industry, you will have known a colleague like this, who was the perfect negative indicator. He only rang him up to ask him what he thought because he knew you should do the opposite. And there are certain elements of the media who don't like the Indian regime. They don't like the fact that I think Narendra Modi is a conservative nationalist. They don't like the fact that actually he thinks it's more important to get electricity and sanitation to the poor people of India than it is to have Greenpeace wandering around the place. Right? He thinks these are far greater priorities. He thinks that the people who should give their attention to the environment and so on are the people who already had their industrial revolution and can afford it. And I tend to sympathise with him in that regard. But it doesn't make him very popular with a certain strain of the media. But their track record is such that I think that it gives me comfort. The latest article that I read on it was actually not about India, it was about Brazil, where there's a forthcoming presidential election, where the publication concerned had an article which was headlined, and the content was Brazilian election may lead to the loss of the legacy of Lula, the president before won. And often in these things, I think the thing to read is not the article, read the comments. So about 90% of the comments under it pointed out to the journalist, who didn't seem to be aware, that Mr. Lula was doing a 12-year stretch for theft. Which might colour your judgment on his record, I would suggest. But what do I know? Very briefly, attribution, because I've gone on for quite a long time. Those are the things that did very well for us since inception. Those are the things that did less well for us since inception and cost us some money. Our best performer is this company, Eastern Tobacco in Egypt, which is our largest position. 3 of the 5, as you can see, are Indian consumer goods companies. Yeah. One of them is the Hypermercasa that we had up earlier has in fact changed its name recently to, Jonathan, how do I pronounce it? Hypera, thank you. There we go. I've checked with my linguist at the back on anything that involves Spanish, I'm afraid. Things that we've lost money on, we're out of the bottom 3. We sold Magnit, the Russian retailer, not because it underperformed, but because we couldn't see it recovering. We thought it had lost an important market position. It would appear that someone agrees with us because Serge Kalitsky, the founder, sold his stake and has handed over to a new management team. So maybe it will recover, and it's still in our investor universe. We'll still think about it, but he seems to agree with us. And we sold the Chinese retail and consumer goods companies, which seem to us to be very badly affected by the rise of digital distribution in China. So we sold out of those. If you look at them in terms of currencies, our biggest gain since inception has been, because we are exposed to currencies, has been in the Indian rupee. But we've had some quite big losers out here. There have been some quite big moves down. The latest one which is occurring is the Turkish lira, which we're endeavouring to, if this is the right term, take advantage of by buying a position back into a Turkish company, whilst the currency is weak. Of course, it may become weaker, so we don't do it all at once necessarily in those circumstances. What worked well last year, you can see that, there's our Egyptian company. It's interesting because it goes back to my thing about cheap versus good and so on. There are lots of behavioural things, which again, the board discusses with me about things like something can have done very well, and it can be your biggest position, but it can still be the right thing to buy. The fact that it's gone up doesn't necessarily affect that judgment. Because the funny old thing is the shares don't know that you own them. They're going to do whatever they're going to do. They're not affected by my position. I might be affected by my position, but they're not. So, you never know with these things. And our other strong performers, as you can see, again, 2 of the Indian consumer staples in there, and Vinamilk, which is our Vietnamese dairy company, which dominates the modern dairy industry in Vietnam. Foshan Haitan is the biggest producer of soy sauce, amongst other things, in China. If things do become difficult in China, as Michael, who analyses it, said to us, if they stop consuming soy sauce, I think we're going to have bigger problems than our portfolio around about that stage of the proceedings. And you can see the things which didn't work very well. You may recall, because I think we presented it, that we exited Famous Brands, another company that developed the Let's Invest in the Developed World disease. So South African-based fast food franchise operation, bought Gourmet Burger Kitchen in the UK. That's, of course, promptly turned into loss-making territory. We promptly lost the shares as well. Magnit, I said we'd sold out from, and this was an IPO in Brazil, which hasn't performed particularly well. It's one of the things in healthcare which hasn't helped us so far. This one, Dr. Al Pass Labs, even though last year it lost some money, it's actually performed very strongly this year. I think the market was very pessimistic about the growth rates in this diagnostic labs business. That's proved to be absolutely okay. And that's the currency for the year to date. I mean, there are swings and roundabouts. Sorry, for last year. You can see India during the year actually wasn't a contributor. It was over the whole period since inception, but not during the year. Tap issues. We've basically done some tap issues, as you can see, in terms of raising more money. 69 million in total at an average premium of 1.8%. We continue to do tap issues. We're seeing more of our colleagues who talk to institutions finding demand to buy shares in this to access the strategy. When they want to do so, providing we can issue at a premium to net asset value and providing the board are satisfied that we can find things to invest in, then we will continue to do them. If all of those conditions do not apply, premium and things to invest in will stop. You don't have to raise any more. And we can find that, and it's at a premium. It's to our benefit to do that with these people. I think people are quite likely to continue doing it if they like the strategy and if they like emerging markets for a very simple reason. As an experiment, we presented this when we launched. I have tried myself, no conflict of interest involved here because I didn't actually want to execute on it, but I've tried to find people who service me as an individual to buy shares in some of these markets like India and Sri Lanka and so on, and it's impossible. It's not impossible to give them an order. It's impossible for you to get impaneled is a term they usually to own them. You have to register to become a beneficial owner. And to say that the process is laborious and expensive would be a vast understatement. Well, our fund has already done that, so it's possible for it to own these shares in these countries. As an individual, it's verging on the impossible. If you want to access these things, something like this is the way to access it. That's all from me.